about a minute and a half. We'll get jobless claims numbers. Expectation 262,000 jobless claims for the last week. I want to bring in Bank of America Merrill Lynch Chief Investment Portfolio Strategist. She's the CEO of the Portfolio Solutions there, Maria Bartels. Maria, good to see you.
Thanks for having me,
Thank you so much for joining us. So we got an economy that is somewhat stuck in the mud. We had a big rally in October. Markets were up about 9%. Is it warranted?
Well, it's very unusual. August was obviously a very bad month. And I think with the Fed staying on hold, the market repriced again and said, OK, we can expand PE multiples. So October is very strange in the sense that you have an 8 or 9% rally. So now that we've had it, I think now you've given up part of the year-end rally. Seasonally now we're in the strongest period for the market, November, December into January. But when you have a very strong October, it takes away from part of that rally. Normally you're up close to 3.5%. So maybe you can get 1 to 2% rally going into year end.
But you're still advising clients to stick with mega cap stocks. It's working.
Correct. We like large cap, high quality companies, good balance sheets. A lot of our clients thought when they came to retirement or close to retirement, they would get 5% risk free in the Treasury market. Well, that's not happening. So in diversifying a portfolio and trying to create income, we're still recommending equities. And when you look at the large cap, high quality companies with clean balance sheets, they're the ones that are paying out the dividends.
So in August, concern about emerging markets and concern about the Fed raising rates led the market to decline. That somehow went away. The concern about the emerging markets, I don't know why, but the Fed didn't raise rates, and so the market rose again. So when concern reemerges about the Fed raising rates in December or January or February, are we back in the trough?
Is it that simple? You know, the Fed doesn't raise rates, market goes up.
Is that what happens?
Well, part of this is also the ECB and Draghi saying that he might even continue quantitative easing. So I think it's ease
fears. But that was kind of already on the table in August, too, right?
It was, but the market felt a little bit more at ease. This whole rate hike, we've been talking about this now for years, and why the market has this much volatility is a little unwarranted. In fact, I think a lot of our clients have fatigue over this. Yeah. So what we really need is for the Fed to do this, get this over with, so we can move on. And I think the story that we're going to have to start talking about is what is 2016 going to look like. Markets discount at least 6 months ahead. So really talking about November or December is really not the issue. It's really what's going to happen in 2016.
Getting back to the large cap theme, I mean, we're seeing stability is there, but we mentioned the DAX earlier. It's up on the day today. I mean, their top holdings are Bayer, Daimler, you've got Allianz, Siemens. Volkswagen is a smaller portion of that index. Daimler and BMW beat yesterday, actually. So they're a larger component. But my question is, how is the European market starting to play in that? Because I look at the DAX index trading at 13 times earnings and a 3% dividend yield, and I'm mentioning these names. It seems like they're being hurt just because their zip codes over in Germany and not in the United States.
And you like Europe.
We do like Europe, and we do feel that it's very attractively priced. And we also like Japan, which is very attractively priced. But we think both of those currencies are still at risk of depreciating, more so the euro. So as we're recommending to our clients to actually be in developed markets like Europe and Japan to hedge the currency. Right. But we do see opportunity. The one market, though, that everybody leaves out is the UK. And if you're really looking for dividends, the UK actually even has a higher dividend yield, normally averages around 4% for some of those companies, a little bit more of a stable currency with the pound. So please don't forget about the UK.
And it has a big chunk of international stock indexes, UK companies. What's going to happen in 2016? You wanted to talk about it. What should the investor expect? What kind of return are they going to get out of the U.S. in 2016?
Well, the markets, in terms of the S&P, are already up 200%. If you look at NASDAQ, it's up 300%. Those kind of gains come after a major bottom. So we're looking for more normalized returns, looking somewhere for returns around 6 to 8% going forward in general for the markets. What we think is important for our clients is to look and hold for the longer term. We do believe we're in a new secular bull market, meaning the market trends higher for years. You'll get bear tapes where markets will go down, but they'll recover and they'll go on to new highs. Too many clients are still anchored in 08, 09. But here's the big story that nobody's talking about is the NASDAQ 100 closed at a record all-time high. We're above the 2000 highs. It's only a matter of time before the NASDAQ itself also gets to all-time highs. That's very tech-related, very innovation-related, which are big themes at our firm.
How does the fundamental backdrop fit in here? Because, you know, I feel like most guests come on and they talk about the possibility of a recession within the next 6 to 8 months. Is that what you, because we've already seen an earnings recession, we've seen an industrial complex recession. Do you expect a recession to hit the economy, and how does that sort of does that throw a wrench into all of this about 2016?
We're not forecasting a recession, so we don't think you should be pricing that in. What we try to really do for our clients, Maria, is to look at what are the major macro themes that are driving our economy over the coming years. And the one that is really driving this economy and can drive it maybe even for hundreds of years is the digital era. And obviously tech is one of the sectors that's really benefiting the most. You're seeing what companies, like disruptive technology, you're seeing what, Uber is doing, Air B2B.
Yeah.
And millennials love technology. They want adaptive change. They want experiences. And so these are major themes that we're focused on, not only in the tech space, but where else within the economy should our clients be investing?
It's like a game changer for healthcare. When you look at technology and what's going on in terms of the sensors all over your body.
Exactly. And then you have, we call the longevity theme.
Yeah.
And the baby boomers now. So you have your two largest demographics playing into this theme. I mean, baby boomers, if you take a person in this country around the average age of 75, some of them can be taking up to 15 pills a day. Do you ever see those pill boxes where it's, morning, early morning, afternoon, late evening? Then the innovation in biotechnology where we're targeting just the bad cells and leaving the good cells. Yeah. So the baby boomers will continue to drive part of the demand for healthcare.
Yeah, there's a higher incidence of chronic diseases. I mean, you're seeing the population of over 60 is going to double by 2050. That's why you're seeing names like Gilead in the NASDAQ 100 do very well.
By the way, I was talking to the CEO of Merck the other day, Ken Frazier, and he told me that if we live to 85, 1 out of 2 people will get Alzheimer's.
Maria, the cognitive charts from 70 to 80 are a ski slope down.
Right.
It's absolutely frightening, and the demands that it will put on and the stresses it will put on the households. And that's what we're trying to help our clients do. That's something that they should plan for. We're finding there are not as many clients that are looking at retirement, making sure that they have the resources that they need to get into retirement and possibly their health care needs down the road.
Really good stuff, Marian. Thanks so much.
Thanks for having me.
Thank you so much for your insights. Marian Bartels.